All right, think about this. In 2024, Tesla pulled in a massive $2 billion in U.S. income. $2 billion. But their federal tax bill? Literally $0. Welcome to this insider briefing. Today we're diving into exactly how the ultra-wealthy pull this off legally. As an executive, you're used to looking at the analytics and optimizing your strategies, right? Well, we are going to look at the ultimate wealth optimization playbook today. We're pulling back the curtain on how the financial rulebook is actually written.
I mean, $2 billion is just staggering. It's pure corporate might, a scale of wealth generation that totally dwarfs a typical American worker's lifetime of earnings. But it sets the absolute perfect stage for us to understand this entirely different financial ecosystem.
Yet somehow, their federal tax bill was exactly zero. Just let that sink in for a second. Zero. While the average professional is stressing over every single deduction on their 1044 form, a $2 billion income resulted in, well, nothing owed to the IRS. Talk about a massive curiosity gap, right? How is this mathematically and legally possible? It really shows us that the rulebook hasn't just been tweaked, it's been fundamentally rewritten. So today, we are exploring a legal loophole hidden right in front of us. It's widely known as the buy, borrow, die strategy. And look, this isn't about shady offshore accounts or illegal tax evasion, not at all. This is a brilliant structural design used by the 1% to avoid paying billions in taxes, and it operates completely out in the open.
Let's kick things off with Phase 1, why salary is a trap and wealth is not income.
To really grasp this strategy, we first have to fundamentally unlearn how we think about making money. Because for the top 1% earning a traditional, high salary, it's actually a massive financial trap. Think about it. On one side, you have a high-earning professional. Say you're making a $200,000 salary. Boom, that triggers an immediate, massive tax bite from the IRS. It's kind of like carrying water in a leaky bucket. The government takes a big scoop out before you even reach your destination. But then, look at the billionaire side. People like Elon Musk or Mark Zuckerberg often take a literal $1 salary. Why? Simply because they want to keep their wealth in untaxed assets, not taxable income.
So the absolutely crucial point here is understanding a concept called realized gains. The IRS only taxes gains when they are realized, meaning you haven't legally made money until you sell the asset. It's exactly like holding a winning lottery ticket. You know it's incredibly valuable, sure, but the tax man can't touch you until you actually walk into the office and cash it in. As long as your stock goes from 1 million to 100 million, it's just paper wealth in the eyes of the law.
Therefore, rule number 1 for the ultra-wealthy executive is remarkably simple. Never sell your assets. I mean, if selling triggers the tax, you just remove selling from your playbook entirely. Problem solved.
But wait, that brings up an obvious glaring question, doesn't it? We see billionaires living these lavish lifestyles all the time, so if you never cash out your stocks, how do you actually fund that billionaire lifestyle? Like, how do you buy a $500 million yacht or fund your private jets if you aren't actually cashing in your chips?
That brings us right to Phase 2, borrow to live, also known as securities-backed lending.
This is where the magic really happens. Here is the exact 3-step playbook to live like a king without ever triggering a taxable event. Step 1. Buy. They put all their money into appreciating assets. Think stocks, real estate, fine art. Step 2. Borrow. They borrow cash against those assets at incredibly low interest rates. And Step 3. Win. They access the cash they need to live on, but because it's technically a loan, it does not trigger taxable income.
Notice the stark contrast here. If you or I need a bunch of cash and we sell stock to get it, that triggers a 20% capital gains tax instantly. Ouch! But for the ultra-wealthy, taking out a loan is legally classified as debt, and debt is not taxable income, so they get cold, hard cash completely tax-free.
Let's look at a real-world example of how this works with a major bank. Say a billionaire walks into Goldman Sachs with $10 billion in stock as collateral. What's the action? They borrow $100 million in cash. The cost to them is a tiny, maybe 3% interest rate. But the savings? By borrowing instead of selling, they instantly avoid a $20 million tax bill. That's a massive win.
And here's where the math gets truly fascinating. As long as their massive stock portfolio grows faster than that tiny 3% interest rate, which, let's be honest, historically the market almost always does, they are mathematically getting paid to hold on to their wealth. The asset outpaces the debt, and the cash they use to live on is entirely tax-free. It's brilliant.
All right, on to Phase 3, the step up,
The ultimate cheat code.
Look, eventually everyone passes away, right? You can't outlive time. But instead of the taxman finally collecting on all that unsold wealth, we hit a legal mechanism called the cost basis step-up. Literally, the legal purchase price of an asset is adjusted to its current market value upon death. Think of it exactly like a video game where, right as you hand the controller to the next player, your entire penalty score magically resets back to zero.
Let's look at this timeline using a prime example, like Amazon stock. Imagine an executive buys an asset at $1 in year 1. Over decades, that asset grows completely tax-free. At the time of passing, let's say that single share is worth $2,000. Because of the step-up rule, when the heirs inherit it, the legal cost basis officially resets to $2,000. All of those decades of massive historical growth completely wiped clean from the IRS ledger. Because of this legal reset button, the heirs can turn around, sell that inherited stock the very next day, and pay exactly $0 in capital gains tax. The tax liability simply ceases to exist. Poof, gone.
And what about that bank loan they were living on? Well, the estate quietly pays off the original low-interest loan using a tiny fraction of the assets, and the heirs are now fully funded to start the exact same buy, borrow, die cycle all over again for the next generation.
Let's bring it all together for the final piece, the real math revealed.
Let's step back and look at the real analytics and the side-by-side impact. This summary clearly contrasts the two realities. Look at the primary wealth source. The average worker relies on a W-2 salary, while the billionaire relies on appreciating assets. For the worker, taxation timing is immediate through payroll taxes. For the billionaire, it's deferred indefinitely. The worker generates cash by selling their time and labor, getting taxed every single step of the way. The billionaire? They generate cash through untaxed bank loans. And finally, at the end of life, the worker's remaining wealth is often taxed, while the billionaire's massive tax liability completely vanishes through the step-up.
Which leaves us with one final, provocative thought to consider as we wrap up this executive briefing on the economic rulebook. Looking at the sheer efficiency of the buy, borrow, die strategy, we really have to ask ourselves, is this tax system fundamentally broken, or is it functioning exactly as it was designed to? I'll leave that for you to decide. Keep optimizing, keep learning, and I'll see you in the next explainer.